A deep nosedive, and our 401ks went with them in many aspects. So now there are some signs, though, that your savings are adding up again. Jason Cowens is a financial advisor and certified financial planner with the Highland Advisory Group, and he's been kind enough to stick around for both hours on this Monday morning. Hey, Jason.
Morning, Scott.
The 401ks are coming back.
Yes.
What are you seeing?
I'm seeing that the people who did the I'm not going to look at my quarterly statements and hold on tight, they're winning the battle now. The ones who were afraid and went to money market positions, all cash position, they're starting to get back into the market slowly.
So let's talk about somebody who was maybe on the conservative side and they were losing, their 401k was tanking, and maybe they lumped a large percentage into a bond fund.
Correct.
Should they maybe bring that money back out?
They should, if they were a moderate investor before and they got scared and went to conservative, go back to their true sense of risk tolerance. Right now, under evaluating your risk, you're going to lose in the big battle. I mean, over the last year, we've seen 18% returns. So go back to your true sense of, if you're a moderate investor, be moderate. If you're conservative, be conservative. Play the averages. Don't be afraid. Don't be betting, but be your normal self. So kind of, you're almost saying stick to your gut a little bit. What feels the most comfortable for you on the inside here? The problem is right now the market, whether you believe it or not, is overvalued. There's a lot of run in there that isn't substantiated. So, you don't want to bet the market's going to continue to rally. There's probably going to be a retraction at some point. So be true to yourself. Be moderate and don't take any wild bets at this point.
Also, we've all probably done a little 401k bashing here the last couple of years, but I was looking at Kiplinger's website this morning, and Kiplinger writes this, or one person wrote this, quite simply, tax-deferred retirement plans are the best gift that Washington ever gave to us American workers.
And that's the thing. I always tell people, when they talk to me about investing, I go, have you maxed out your 401k? That's first and foremost. Then you start to look to IRAs, Roth, things like that. Get all the tax breaks you can, because that's the battle. Death and taxes, those are the certainties in life. So go with there.
Hey, you know what? Let's look at our crystal ball a little bit. Let's go to 2010. What if there are people out there and their companies next year are going to either freeze their 401ks or stop the match? What should those people do? And
that gets into the fine line. It's still looking for tax deferral. So the way I always tell people is, when you have a 401k, you're usually buying in a group environment. So your cost, the commission costs, the expense ratios are typically lower than you can get on the outside. So you should still look at that 401k as a lower cost vehicle. If they're not going to match, maybe you can do a little more control and say, maybe I want to do a Roth, because that's going to be after tax when you take it out. So looking at a strategy that way, because once you start to buy on the retail side, there's going to be a lot of higher expense ratios, a lot of commission fees that are going to eat away at your profitability. So stick to the lower cost instruments first.
From what your research is showing you, have most companies made the adjustments they're going to make in their 401ks, or do you think more of the big employers out there could again make some changes in 2010?
I think we've seen the worst of it. I mean, because they were laying off people and they were freezing up matches. So I think those are a lot of the breaks. There's probably going to be a ramp up. They're probably not going to go back to their typical 6% match. They might step in at 3%. But if a company freezes your match, that's not as big a concern as them not offering a 401k.
Okay. I got 10 seconds left here. What sectors do you see that are going to be good, especially heading into this fourth quarter of the year?
Easy ones are energy, raw materials, technology. Internationally, look at China. Those are the biggest.
Follow China. Okay, the money leads to China. Jason Cowens, as always, we appreciate your insight and your advice. So, Sram, we'll send it back over to you.
Okay.